In today's video, I am going to be breaking down some of my top 5 picks for the 2021 year when it comes to high dividend paying ETFs. Now, these are all ETFs that have substantially higher dividends versus other ETFs that are out there, and also some stable numbers when it comes to the underlying equity of the actual ETF. The other thing that I'm going to mention before this video starts is the fact that the ETFs at the end are going to be some of the highest paying ETFs in Canada. And of course, there is going to be a special case right at the end, so technically there will be 6 ETFs that I mentioned. Let's get down and let's break down this first ETF. So this first ETF is labeled XEI. So if you were to type in XEI ETF on Google, or if you just type in XEI on your trading platform, you will be able to find it. It is the iShares S&P TSX Composite High Dividend Index ETF. Basically, this is going to be picking a lot of the dividend payers, a lot of the higher dividend payers, and essentially putting them together into one fund. As we can see, it has not had a very good year, but really, who has? Let's face it, this virus has really done damage to the economy. From there, when we start scrolling down, we want to look at some of the key facts. That's going to be the price, the dividend, things like that. Number 1 is how many stocks does it hold? It holds 75 stocks, 75 different companies. From there, we're going to be looking at the price, and the price is currently at $19.66 at the time of making this video. From there, we're going to be looking at the distributions per share, and I'm going to tell you right now, every single ETF I mention in today's video is going to be paying a dividend every single month. And this ETF itself pays on average, currently at current prices, roughly 4.5% over the year, which equates to about 8 cents per month. Roughly, it does vary with this ETF every single month. Some of the ETFs later on in this video are pretty straightforward. They do not vary their dividend as much. So way back, just before 2011 was when this was first originated, this fund, and since that time it has gone up about 75% in roughly 8 years. Now, what you will find when it comes to dividend paying stocks, they don't tend to go up as high as non-dividend paying stocks, but you are making an income from it. And if you reinvest those dividends, if you're younger like myself, then generally speaking, you will have a greater return than you would when it comes to a regular stock that does not pay a dividend. In theory, it doesn't always happen, but when you start looking at blocks of companies, that is generally what happens. And then you want to look at the holdings, and in this ETF we have TD, Royal Bank, Bank of Nova Scotia, CIBC, basically these 4 of the top 5 banks in your top 4 holdings. So when you start looking at how much you're putting in, you're essentially looking at just over 20% of your input into this ETF is 4 banks. Now, what does that mean? Well, that means to me that if you want to hold this ETF, you may be better off holding just the stocks itself, some of the top stocks, and that way you can save on the MER. Now, the MER in this fund is about 0.2% on average. However, what I like to keep remembering or telling myself about this ETF is the fact that you have to go and dig into their actual literature before you actually see the MER. You don't see it on their website, so it kind of seems like they're trying to hide it for some reason. But their exposure rate is mostly in financials and energy, which is, of course, most of the Canadian market anyway. So sometimes when you start looking at some of these ETFs, you can see that sometimes it is better off just holding the individual stocks, especially when you're just getting paid over 4.5%. This next fund is by Vanguard. It's VDY. It's the Canadian High Dividend Yield Index. The MER in this one is nice because it's right out there, right on their top of their page, which is beautiful, at 0.22%. And its current market value is $33 per share at the time of making this video. From there, what I actually really do like this fund. So this Vanguard ETF is basically to track the actual Canadian Dividend Index, which is basically holding the top stocks that are paying the dividends. Very similar to the last one. Since the inception in 2012, we now see at the top, at the peak, that it was just past 18,000. That's an 80% return in about 8 years, so it's a little bit better than the last ETF that we just mentioned. Now, the yield as of November was 5.76%, but the trailing was 4.66. I like to look at this because it's the most current. It's generally right now roughly in that 5.5% range, so it's paying a little bit more than the last ETF we just mentioned, XEI. However, the nice thing with this one is they have been increasing the dividend substantially over the past couple of years, actually ever since inception. Some ETFs keep their dividends the exact same throughout the time, so that is something to definitely keep your eye on. Now, the third ETF that I'm going to mention is ZDV. It's the BMO Canadian Dividend ETF. It's very similar to the last two. However, this one's nice because it does give you essentially the same dividend over the year, and this one does occasionally increase its dividend as well. It is currently sitting at $16.34 a share at the time of making this video, which makes the annualized distribution at around 4.76%, which is now getting it close to in line with XEI. However, the actual fees are a bit higher than XEI, so keep that in mind as well. It's about 1.1 to 1.15, higher when it comes to the MER, and you are getting less dividend as the last ETF from Vanguard. However, you are getting it at a cheaper price per share, which may help you get in an extra couple of bucks, but we do have a very good market volume, and I just really like the BMO ETFs in general because their website is super clean, very easy to understand for everybody as well. Now, since inception, which is in the 2011 range, since then, in about, I'm going to say 10 years to the peak, I'm not going to count the current times because, of course, COVID, but from there, an 80% return, which puts it on mark with Vanguard and a bit better than XEI, which was that first video. As mentioning, it does have the same dividend throughout the year, which is nice to see. It makes your ability to know what's coming in the future to really help you out. Now, with holdings, the holdings are staggered a little bit. So you are still getting banks in the top two, but third and fourth are different companies. You're getting BCE, and then you're also getting Enbridge, and then you're going back to the banks, and then you're going back to telecoms. So you are getting more banks in the top 10, but you are getting a little bit more exposure to other things higher up in the list. Now, ZWH is also a very interesting ETF. Now, this is another BMO ETF, and this one's paying a bit higher of a dividend. So this is a covered call ETF. The other three that I mentioned are not covered call. Covered call is going to protect you on the downside, but it's also going to stop you from having the massive upside. It's going to keep you especially in line with the hopefully plus side of the actual market, and you are making money on the covered call side of things. So with the covered call strategy, essentially at that point you're making your dividend from the actual premiums of the options that you are selling or you are having, and from there, or selling I should say, and that would equal 6.6% at this point in time. A few months ago that was up into that 8% range, which was absolutely amazing. Market volume is 163,000 shares per day on average. We can see that right here, and as we can see, it is a monthly distribution as well. So since inception, which is 2014, we have seen a nice doubling, which is great. So this is going to give you at least historically, a better return on your underlying equity. And then it's also going to give you that 6% dividend. So this is why this one's making it closer to the top of my list. However, the MER is 0.7%, so that is double than the other ETFs that we do have on this list. Now, the top holdings is Apple, Bank of America, JP Morgan, Microsoft, some massive companies that do pay dividends. And, of course, companies like Apple have a lot of options available, same as Bank of America. So this is why they're able to have such a high dividend. Another very high dividend is the BMO Canadian High Dividend Cover Call. Now, this one is $16 per share, as we can see at this point in time, but it is another covered call option, which means that we are making money off of the premiums from the call options, which means we get currently an 8.08% dividend. Massive, huge, love it. 0.72 MER, which is understandable. It's the same management expense ratio as we've seen in the last ETF, but you are now getting up into huge dividends. So this was up close to 10% back when we had that dip, and it would have been fantastic to get a lot of it back then. However, a lot of people did not capitalize on that if they didn't even know about this possibly at all. Who knows? But now you guys do. It is another one that does pay monthly. Its inception was 2017, and of course, since that 2017 inception date, it's up 16%. So underlying equity, not massive gains, but pretty solid gains with a massive dividend. Now, time for my bonus. This is a massive ETF that is new, and of course, I've bought into this because I just love the dividend. So it is ZWK. You've probably seen it on my channel before. It is the BMO US Bank Covered Call ETF. It is currently trading at $25 per share, and it has a massive 8.8% dividend as of December 18th. I think it's close to about 8.5 right now. And from there, its market volume is huge. It's got 82,000 shares average per day, and its MER is 0.71, so keeping it in line with other covered call ETFs. Its risk is a bit higher, but I think the return is also much higher as well. And we'll see that when we get to the all. Since inception, if you started with $10,000 and you are now, before the downturn, you are at 11%, and that ends up being in a year, which is massive. This is going to give you potentially massive equity gains with a massive dividend. It does pay a pretty standard 18 cents per share, except for 1 month was down to 16 cents per share. And the holdings, the long-term holdings, are right there. Big banks in the United States and big dividends. Now, from there, what we do like to see as well is these are all banks that have a lot of options that are trading. So this is why the price of the dividend is so high on this ETF. I hope that you have enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.